Picture this. You hand your rental property paperwork to your tax agent every July. You sign where they tell you to, and you assume it's all correct. Here's something that might surprise you. When the ATO recently reviewed more than 300 rental claims, it found errors in almost 9 out of 10 of them. 9 out of 10. And if you're one of them, it's almost certainly not because you did anything wrong on purpose. Most owners simply weren't told how these rules actually work, and that's exactly what I'm going to walk you through today. And if this is you, please don't feel singled out. Owning a rental property in Australia comes with some of the trickiest tax rules going, and nobody hands you a manual. The ATO estimates incorrect rental claims add up to a $1.2 billion gap every year. So today I'm going to give you 3 simple moves to get your own return right. Audit your deductions, reconcile your rent, and build a 5-year record trail. Each one is free, and each takes you under 30 minutes. Stick with me, because the first number I'm about to show you reframes the whole thing. Let me land the number that matters for you. $1.2 billion a year. That's the ATO's estimated annual rental tax gap for individuals like you. And here's the part most people never hear. Incorrectly claimed interest alone makes up 42% of that gap, around $504 million a year, just from loan interest that wasn't fully deductible. If you have a loan against your rental, this is the single most likely place your return could be wrong. So here's your plan, and it's genuinely simple. Move 1. You audit your repairs, capital works, and interest. Move 2. You reconcile your gross rent and your ownership shares. Move 3. You build a 5-year digital record trail. That's the whole thing. 3 moves, all free, all doable from your couch, and I'll show you exactly how to do each one. So where do things actually go wrong for you? The first area is misclaimed deductions, and there are 3 usual suspects. First, repairs versus capital works, claiming a whole renovation in 1 year when the rules say you spread it out. Second, interest, claiming 100% of your loan interest even after you've redrawn money for a car or a holiday. And third, private use, like a holiday home you block out for family but still claim in full. These aren't gray areas the ATO might overlook. They're the rules, and knowing them is what protects you. Let me show you what this looks like in real dollars, because the number depends on the size of your renovation. Say you spend $20,000 on a bathroom and claim it all in year 1. Under the rules, that's capital works, deductible at just 2.5% a year. So you don't get $20,000 now, you get $500 a year. If your reno was smaller, say $10,000, that's $250 a year. If it was bigger, closer to $30,000, it's $750 a year. Get the $20,000 one wrong at a 37% tax rate and you've underpaid over $7,000 on that single claim. Now here's the part most people miss, and I want to be completely honest with you about it. The second problem area is income and reporting, and here's the uncomfortable truth. The ATO found the majority of owners made errors despite 86% of them using a registered tax agent. So using an agent isn't a shield. The classic slip-ups are leaving Airbnb or stays income off and double claiming, where your agent takes their fees out of your rent, sends you the smaller amount, you report that smaller amount as your rent, and then claim those same fees again. And here's why these slips now catch up with you. The ATO cross-checks your property against data from banks, land title offices, insurers, property managers, and platforms like Airbnb. So if you understate income by $5,000 and overclaim by $5,000, that's a $10,000 gap, about $3,700 in tax a year at 37%. Run that for 4 years and you're looking at $14,800 before any penalties or interest. But there's one belief that stops most people from ever checking. Let me bust it next. Here's the myth I want to clear up, because it keeps people from acting. My accountant handles it, so it must be right. I understand why you'd think that. You're paying a professional. But remember, 86% of the owners who got it wrong were using a registered agent. And here's the bit that really matters. When there's an error, the ATO holds you liable, not your agent. That's not a reason to panic. It's a reason to glance over your own rental schedule, line by line. You don't need to be an accountant to spot the 3 things we're covering. Let me put the 2 costs side by side so it lands. Nationally, wrong interest claims drain about $504 million a year, but the number that matters to you is the personal one. For a single mid-income landlord, the modeled 4-year bill from typical heirs, tax plus penalties plus interest, can reach around $23,500. A national billion-dollar gap quietly becomes a very personal 5-figure bill. Let me show you exactly how that adds up with a real example. Let me make this concrete with someone whose situation might feel familiar. Meet Lisa. She's 38. A marketing manager in Sydney on $110,000. She owns one investment unit she bought for $650,000, with a $520,000 interest-only loan bringing in $32,000 a year in rent. And here's the important part. She uses a registered tax agent every single year, just like you might. Here's what she found when she actually looked. Discovery 1. Lisa spent $18,000 on a bathroom refresh and claimed the whole lot as a repair in year 1. But under the rules, that's capital works, deductible at 2.5% or $450 a year, so she overclaimed $17,550. At her 37% rate, that's nearly $6,500 in underpaid tax from a single renovation. If your own reno is sitting in the repairs line, this is the first thing to check. Discovery 2 adds another layer you'll want to watch for. 2 years back, Lisa redrew $40,000 from her investment loan to buy a car, but kept claiming 100% of her $26,000 in interest. Only the investment portion of a loan is deductible, so the part tied to the car was actually private. About $2,000 of interest a year shouldn't have been claimed. Over 2 years, that's $1,480 in underpaid tax. If you've ever redrawn against your investment loan, this one likely applies to you. And Discovery 3 is the one I see most often. Lisa's property manager collects $32,000, keeps $4,000 in fees, and sends her $28,000. Lisa reported the $28,000 as her rent, then claimed the $4,000 in fees again. That's an $8,000 understatement of income every year. Over 3 years, that came to $8,880 in underpaid tax. This is the exact trap that the gross versus net move will protect you from. Now let's add it all up, because this is where it gets real. Over 4 years, Lisa's underpaid tax came to about $16,850. Add a typical 25% shortfall penalty, roughly $4,200, plus around $2,500 in interest, and her total exposure is about $23,500. 1 unit, 3 honest mistakes. That's the cost of not checking, and the good news is, checking is free. So could this be you? Here are 3 quick signs. 1. You've claimed a renovation as an instant repair deduction. 2. You don't actually know how much of your loan was redrawn for private use. 3. You've never matched your declared rent against your agent's statement. If even one of those rings true, don't worry. That's exactly what the 3 moves are for. Do them before you lodge again, and you're covered. So where does this leave you? You don't need to overhaul anything. You just need 3 specific practical steps, and you can start every one of them tonight for free. Let's walk through them together. Move 1. Audit your deductions. Log into MyGov, link the ATO, and open your rental schedule under Tax, Lodgements, Income Tax. Go through every large item, bathrooms, kitchens, appliances, and ask yourself, is this a genuine repair or is it capital works that should be claimed at 2.5% a year? Then check whether your interest includes any private redraw. This is general information, not personal tax advice, but it's exactly the check that catches the biggest errors. Here's how to do it in 3 steps. Open your rental schedule in ATO online. Flag any renovation that's been claimed instantly instead of as capital works. Then work out your private versus investment loan split. What good looks like. Your renovation sitting on the capital works line and your interest correctly apportioned. Once that's done, you've handled the single most expensive error category. Move 2. Reconcile your rent. Pull your property manager's annual statement and any Airbnb or stays dashboards. Add up the total gross rent you receive from every source, then compare it to the gross rent figure on your ATO schedule. And if you own the property with someone else, make sure each of you reports your legal share rather than one person claiming the lot. 3 steps again. Total all the gross rent you received across every source. Match it to the gross rent line on your ATO schedule, and confirm co-owners each report their share, not 100%. What good looks like. Your declared gross rent equals your statement totals, with nothing missing and nothing counted twice. This is the move that protects you from that double claim trap we saw with Lisa. Move 3. Build a record trail. The ATO requires you to keep your rental records for at least 5 years, so set yourself up properly now. Create one digital folder with subfolders for interest, repairs, capital works, borrowing costs, income statements, and private use evidence. I know it sounds tedious, but this is genuinely the difference between a 5-minute query you answer with a click and a 5-figure bill. Here's the 3-step version. Create your folders: interest, repairs, capital works, income. Scan every receipt showing the supplier, ABN, amount, and date, exactly as the ATO wants it. Then add a 1-page summary each year showing how you worked out each figure, what good looks like. 5 years of records, with every single claim traceable back to a document. That's the trail that turns an audit into a non-event for you. Now, why does all this matter right now rather than someday? Look at the timeline. In 2023, the ATO ran over 300 random rental audits and found errors in 9 of 10 returns. In 2024, it publicly named rental properties a top compliance priority and put tax agents on notice. And in 2025, it's actively data matching banks, land titles, and short-term rental platforms. Here's the part that should focus your attention. The ATO can amend up to 4 years of your past returns, so the window to quietly fix this is closing. Once you've acted, take 2 minutes to verify it. You should see your renovation sitting on the capital works line, not in repairs. Confirm your declared gross rent matches your statement totals exactly. And if you do uncover a past mistake, here's the good news. Lodging a voluntary amendment yourself before the ATO comes to you usually reduces any penalties significantly. Coming forward genuinely works in your favor. Every source behind today's numbers, the ATO media releases, the CPA Australia guidance, and the compliance guides, is linked in the description below if you'd like to read it for yourself. Always worth checking the original wording when it's your money on the line. So here's where you've landed. You now know the 3 rental errors the ATO actually hunts for, and exactly how to check your own return against each one, which puts you ahead of most property owners out there. The single best thing you can do tonight is open your rental schedule in MyGov and check that first renovation line. And if you want to keep more in your pocket, the negative gearing rules the ATO quietly hopes you misunderstand are exactly what we cover next. If today saved you from a nasty letter down the track, the best thing you can do is take that first move tonight and come back for the next one. There's always another tax rule working quietly in your favor once you know where to look. I'm Sophie, and I'll see you in the next one.